Our objective is to make you financially independent. Watch this video to master how to survive a financial storm coming in 2024. Warren Buffett, the investing genius, has rung the alarm bells for 2024. So, how can you prepare to face the challenges and seize the opportunities hidden within the storm? In this video, you'll learn exactly what he's warning us about and, more importantly, how to prepare for it so you can turn it into an opportunity. Let's get started. Warren Buffett is sounding the alarm about something big that might make history repeat itself, and this time, it could be worse. He warns of a looming economic storm, drawing parallels to historical crises such as the 1929 Wall Street crash and the 2008 Great Recession. The 1929 Wall Street crash, recognized as one of the most devastating financial events in modern history, marked the onset of the Great Depression. Driven by speculative trading, stock overvaluation, and a lack of regulatory oversight, it led to widespread unemployment, bank failures, and a prolonged economic downturn throughout the 1930s. The 2008 Great Recession, triggered by the collapse of the housing market and the ensuing financial crisis, remains fresh in our collective memory. Rampant subprime mortgage lending, complex financial instruments, and global market interconnectedness intensified the recession's severity, prompting worldwide government interventions. With that out of the way, let's break down what he's cautioning us about. Warren Buffett is pointing to a massive debt problem in the United States. In just the first 9 months of the fiscal year 2023, the U.S. borrowed a staggering $1.4 trillion. To put that into perspective, it's like borrowing the cost of a small country's annual budget. In June alone, the U.S. borrowed $228 billion. But why is this debt such a big deal? Here's where the real estate bubble comes into play. Low interest rates make it easy for people and businesses to borrow money, so everyone starts buying homes and property prices shoot up. But when interest rates rise, things get tricky. If, for example, a young couple's mortgage has a variable rate, their payments go up as interest rates rise. If their income doesn't grow at the same speed, they might struggle to make those higher payments. If they can't, the house goes back to the bank, and we have a problem. The same happens in the commercial real estate world. Business owners buy property when interest rates are low, but if rates climb and economic challenges hit, they might not keep up with loan payments. When many people and businesses can't pay their mortgages or loans, the market faces a surge in foreclosures. Suddenly, property values drop, leading to lost equity and financial distress. Now let's talk about something called non-recourse loans. Imagine borrowing money to buy a building, and if things go south, you can just give the building back to the bank and walk away without owing more money. Sounds like a great deal for the borrower, right? But Buffett is warning us that this can be risky for the banks. If many people start handing back buildings to the banks, the market gets flooded with properties, prices drop, and everyone feels the impact. This kind of deal might seem less risky for buyers, but can mess up the economy in the long run. It's like a game of dominoes. One piece falls, and the rest follow. Let's talk about the ripple effect. Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." This quote is like a guiding light, especially when we look at the real estate market. When small regional banks get greedy and lend out loads of money during good times, they put themselves in a precarious position. If property values drop or businesses struggle, these banks are hit hard. This has a direct impact on small businesses. When local banks face problems, getting loans becomes harder for small businesses. They might need money to grow, hire more staff, or just keep the lights on. If banks tighten their belts, these businesses are left in a tough spot. We now shift our focus to the stock market. Big names like Tesla, Alphabet, and Nvidia have seen their stocks tumble. These aren't just tiny dips, they're signs of bigger trouble on the horizon. Part of this turbulence comes from recent jumps in interest rates. Since March 2022, the Federal Reserve has been raising rates from a tiny 0.25% to a whopping 5.5%. And now, we're all left guessing what they'll do next. This uncertainty is making everyone in the stock market nervous. Buffett compared interest rates to gravity for stock prices. Just like gravity pulls an apple down, higher interest rates can pull stock prices down. They make borrowing more expensive, which can slow down spending and investment, two things big companies thrive on. Looking ahead to 2024, we can expect the stock market to keep feeling this pressure, especially for companies that rely heavily on borrowing. So, what should we do to prepare for what's coming in 2024? 1. Leverage Buffett's investment wisdom. Warren Buffett has always emphasized a simple but profound principle. Be fearful when others are greedy, and greedy when others are fearful. How does this translate to the real estate market? Well, it means we should be cautious and thoughtful in our investments, especially during times of economic uncertainty. If others are rushing into real estate because it seems like easy money, take a step back. Consider the long-term implications before diving in. 2. Stay informed about the stock market. Buffett's wisdom extends to the stock market as well. He once likened interest rates to gravity for stock prices. Just as gravity pulls an apple down, higher interest rates can pull stock prices down. So, what can investors do in the face of this uncertainty? It's crucial to stay informed and understand the relationship between interest rates and stock prices. As we approach 2024, keep an eye on how interest rate changes may impact the stock market. 3. Practice investment strategies for uncertain times. In uncertain times, the golden rule of investing remains: stick to your financial plan. This is your guiding star when the seas get rough. Diversification is vital. Don't put all your eggs in one basket. If you're feeling uneasy about stocks, consider shifting some of your portfolio cash into longer-dated bonds. These bonds can act as a safer harbor when the stock market gets choppy. Real estate, while a tangible and often lucrative investment, requires a cautious approach. If you're thinking of buying property, make sure it's for the right reasons, not just because prices are rising in a bubble. What goes up can come crashing down. For those already invested, keep a vigilant eye on market trends and be ready to adjust your strategy accordingly. 4. Seize opportunities during the downturns. Warren Buffett isn't one to shy away from challenges. In fact, he sees them as opportunities. His approach during downturns is to view them as chances to grow your portfolio. While most are fearful, Buffett remains greedy. Not in a negative sense, but in seizing the opportunities that adversity presents. As we head into 2024, remember that recessions will come and go. If you're too scared to invest during challenging times, you might miss out on the good times too. Take a page from Buffett's playbook and view tough times as a chance to grow your portfolio. Are you ready to implement Warren Buffett's wisdom and navigate the uncertainties of 2024? Let us know in the comments. Subscribe, and if you enjoyed the video, check out our other insightful videos.